And Amira.
We've got a really intense Tuesday, June 23, 2026 trading session to break down today. I mean, U.S. equities just suffered a pronounced tech-heavy sell-off.
Oh, absolutely. And we saw this relentless U.S. dollar surge that completely crushed major commodities, like gold and crude oil.
Yeah, it was brutal.
Yeah.
But to briefly conclude the market before we really get into it, despite those massive headline drops in the NASDAQ and commodities, fixed income and credit markets were honestly oddly insulated and completely calm.
It's super strange divergence. You'd think there was total panic, but bond traders were basically yawning.
Right. And we're going to unpack exactly why that happened in this deep dive. But really quickly, just a reminder, this deep dive is for market context and discussion only.
Yeah, strictly educational, so not personal investment advice or an investment recommendation.
Okay, let's jump right into session one. What set the stage before the U.S. session?
Good question. We really have to look at the hangover from yesterday, Monday, June 22.
Right, because heading into Monday's close, markets genuinely thought the U.S.-Iran Memorandum of Understanding to, reopen the Strait of Hormuz was a done deal.
They absolutely priced it in, but early Tuesday morning, that narrative just totally fractured.
It really did. If we look at the conflicting accounts impartially, on Monday at 4 p.m. Eastern Time, Donald Trump claimed Iran agreed to strict nuclear inspections and that oil was freely flowing.
But then contrast that with the Iranian pushback early Tuesday. At 7:43 a.m. Eastern Time, their foreign ministry spokesperson, Baghai, and the UN ambassador firmly denied it.
Yeah, they said missile capabilities or IAEA inspections were definitely not part of the agreement.
Which sounds like a deal breaker, right? But honestly, I'd challenge the idea that this conflict means the deal is dead.
Oh? Why is that?
Well, we've talked about geopolitical brinkmanship as bargaining leverage before. These public denials might just be aggressive negotiating tactics for the upcoming 60-day window.
Oh, that makes a lot of sense. Posturing for their domestic audience.
Exactly. And the proof is in the pragmatic workaround they set up. Because at 4:18 a.m. Eastern Time on Tuesday, Oman and Iran quietly established a joint committee to manage Hormuz shipping.
Wow, so they're actively coordinating with the International Maritime Organization.
Yep. It's a highly practical mechanism to just keep those 17 million barrels of oil flowing, regardless of the rhetoric.
Right. Though we also had the Lebanon ceasefire stress test, keeping everyone on edge. Hostilities were flaring in Lebanon, which is obviously an Iranian red line.
Yeah, and we saw U.S. officials like VP Vance and Secretary of State Rubio actively intervening to save that truce.
So the Middle East was already a powder keg. But then, if we look at Europe, the inflation anchor was slipping.
Oh, big time. At 4:18 a.m. Eastern Time, ECB officials, including Chief Economist Philip Lane, came out with a serious warning.
Right, warning that the recent energy shock is feeding into broader inflation, and price growth could stay above 2% deep into 2027.
Which is classic inflation as a self-reinforcing loop, and it wasn't just the ECB.
No. At 9:25 a.m. Eastern Time, Bank of Canada Governor Macklem also warned about leveraged non-bank financial risks and Chinese capital outflows.
So just to wrap up this first part, heading into the U.S. Open, investors were already juggling fragile geopolitics and some really sticky inflation warnings.
Totally. Let's take a quick break, and then we'll dive right into the U.S. trading hours.
Sounds good.
Moving into session two, what moved markets during U.S. trading hours?
It was all about the data, honestly. At 9:45 a.m. Eastern Time, the S&P Global Flash U.S. PMIs hit the tape and just absolutely crushed expectations.
It was huge. The composite PMI registered 52.2, driven by this massive manufacturing PMI beat of 55.7.
Yeah, against a 54.6 forecast.
So what was the immediate market cascade from that?
Well, that blistering data reinforced a higher-for-longer rate path. The bond market realized the Fed is stuck, and that lit a fire under the U.S. dollar index.
Right. The DXY surged from 101.000 to peak at 101.43, which just reinforces dollar strength as imported inflation for everybody else.
Exactly, and that triggered a violent commodity capitulation. I mean, gold plunged over 100 points.
Wait, 100 points intraday?
Yeah, from 4,216 down to an intraday low of 4,108.20. And WTI crude slid to a low of 72.48.
That is wild. And that strength bled into the equities too, right? We saw a massive tech-heavy sell-off.
Oh, definitely. NASDAQ futures plummeted from an early high of 30,701.25 all the way down to 29,577.25.
Ouch. And the S&P 500 closed lower at 7,365.46, with the VIX spiking up to 20.54.
It felt like panic on the screens.
Honestly, though, I'd challenge whether the NASDAQ drop is truly a panic. I think it's just a mathematical certainty.
Really? How so?
Well, remember, discount rates is financial gravity. With these hot PMIs and hawkish ECB talk confirming rates aren't dropping, the valuation multiples of long-duration tech equities simply had to compress.
Right, the air gets thinner up there. That makes total sense, and that perfectly explains the credit market anomaly we saw.
Exactly. Fixed income was so calm.
Yeah, despite the equity and commodity violence, the 10-year Treasury note just chopped in this super narrow 109.20 to 109.55 range.
And corporate bond ETFs like HYG and LQD closed essentially flat.
Because the underlying economy is still humming, they aren't worried about defaults.
Okay, so to briefly wrap up session 2, we saw a serious macro beatdown on commodities and tech duration driven by strong data and a surging dollar. Let's take a quick break before our next session.
Right. We've got some wild corporate events that completely defied that broader market slump.
Welcome back, session 3, corporate events recap and what to watch next.
So we talked about the macro tech sell-off, but the underlying micro reality is completely different. Big tech is still spending wildly.
Oh, the AI capex juggernaut is just plowing ahead. At 6:58 a.m. Eastern Time, headlines confirmed a massive acceleration of global capital commitments.
It's staggering. Abu Dhabi's MGX is raising $50 billion for AI deals.
Wow.
And Blackstone announced a $30 billion plan just for Japanese data centers.
And Microsoft completed its Wisconsin data center, which is part of a $4.7 billion regional spend. It all really points to power access as the AI bottleneck right now.
Oh, for sure. And you can clearly see AI spending as sticky inflation here. All this infrastructure requires massive physical resources.
Speaking of massive, during U.S. trading hours at 12:13 p.m. Eastern Time, SpaceX launched its debut U.S. dollar high-grade bond offering.
Yes. They raised $25 billion with a staggering peak demand of $90 billion.
$90 billion. That's insane. And they used part of that momentum to sign a $6.3 billion computing deal with the open-source AI startup Reflection.
Right, to secure NVIDIA GB300 chips. It's absolute proof of AI capex as a cycle-agnostic arms race.
Yeah, they are locking up capital and compute regardless of this broader macro choppiness. They just don't care about the high rates.
They really don't. But we did have some serious corporate policy headwinds today, too.
Right. At 12:40 p.m. Eastern Time, Alibaba sued the U.S. Department of Defense in a California federal court to get off the Chinese military companies list.
And carrying over from our prior session, we can't forget Donald Trump's proposed ban on stock buybacks for defense contractors like RTX, Lockheed, and Boeing.
Right. The goal there is to force munitions production instead of buybacks. But impartially speaking, we all know stock buyback bans as EPS compression.
Exactly. And that mechanical reality led to serious intraday volatility today for the industrial sector, XLI.
It definitely did. Well, on that note, if your portfolio took a hit in today's tech sell-off, just remember that Blackstone and Microsoft are still spending billions. Go ahead and pour yourself a strong drink. Tomorrow, you might be strictly on tap water.
Huh. I think a few commodities traders need that drink today.
No kidding. So here's what to watch next on the economic calendar. Wednesday, 9 a.m. Eastern Time. Fed Governor Christopher J. Waller speaks at the Fed's 5th conference on the international roles of the U.S. dollar.
And at 10 a.m. Eastern Time, Census Bureau May new home sales.
Finally, 10:30 a.m. Eastern Time, the EIA Weekly Petroleum Status Report.
All right, time for our bonus on-air session.
Yep, paper trading. Just a quick recap. We started this live paper trading experiment back on April 17th, 2026, with $10,000 limited to 13 macro ETFs and 10% constraints.
And as of today, June 23, our current value is $10,842.34. That is an 8.42% return.
Which is comfortably outperforming the S&P 500's 3.36% return, with the index sitting at 7365.46. All right, I'll kick off my trades for tomorrow. I'm selling XLI at 0.5%, selling XLK at 8.7%, and buying XLF at 9.2%.
Nice. What's the justification there?
Well, we know energy prices as a consumer tax, right? So the Hormuz oil drop we talked about acts as a stimulus, which shifts leadership to cyclicals.
Right, that makes sense.
Yeah, so I'm buying financials XLF to ride the hot PMIs and higher for longer rates. I'm selling industrials XLI to dodge that Trump buyback ban EPS compression. And I'm selling tech XLK because of China's tech retaliation and those high discount rates.
I agree with you on the XLI sell, so I'll keep that. But I'm taking a different route on the rest. I'm selling XLU at 9.4%, buying XLK at 5.0%, and buying XLE at 5.0%.
Wait, you're buying tech and energy today?
I am. So I'm dumping utilities, XLU, because they're a bond proxy getting crushed by high discount rates. But I am buying tech because that cycle-agnostic AI arms race is just undeniable. And I want exposure ahead of Micron's earnings.
Fair enough. What about energy XLE?
I'm buying energy because the Hormuz deal is incredibly fragile. Relying on tail risk removal as the market trigger might be super premature. Plus, the U.S. Strategic Petroleum Reserve is at its lowest since 1983, so there's a hard floor.
Oh, that's a really solid point on the SPR. Okay, let's aggregate these final decisions for the close of June 24.
We are going to buy XLE at 2.5%, buy XLF at 4.6%, sell XLI at 0.5%, sell XLK at 1.8%, and sell XLU at 4.7%.
Perfect. And remember, this paper trading is just a live experiment for discussion, not financial advice.
Yep, don't trade your real money on this.
We'd love to hear your thoughts on today's massive market divergence, so be sure to let us know down in the comments.